Discussing this question, and the video stopped again. On the asset side, you can see fixed asset tangible 2,74,000, 1,17,000. Non-current investments, that is 68,000 and 55,000. Current assets, inventory, trade receivable, and cash equivalents. Inventories, it is 2,06,000 and 1,50,000. Trade receivable is 32,000 and 70,000. Cash and cash equivalent is 95,000 and 70,000. There are no additional informations given. So directly we can start with the balance sheet statement of profit and loss. Generally we start with this, but after starting with this we add any extraordinary items like gain on sale of plant and machinery is subtracted, loss on sale of plant and machinery is added, insurance claim received is subtracted. These are the extraordinary items. In this question, since we don't have any extraordinary item, we can directly start from here. Net profit before tax and extraordinary items. Net profit before tax and extraordinary items, we can directly start from here because there are no extraordinary items given in the question. You don't need to follow the cash flow statement full format. Even if the items are not written, you don't need to write the topics for that. Understood? If there is no extraordinary item, you don't need to start with closing balance of surplus, then you will subtract the opening balance of surplus, then you will get the net profit during the year, then you will add the extraordinary items. You don't need to follow that process if there is no extraordinary item. If the extraordinary items are given in the question, then you need to do that, or else you can skip those portions. You can directly come to the net profit before tax and extraordinary items. That is the difference between statement of profit and loss, surplus balance. Surplus balance is given here, 82,000 at the end of 31st March 2018 on the end, 82,000. On 31st March 2019, it is 1,83,000. 1,83,000 minus 82 will give you 1,01,000. That I have written here. 1,01,000 net profit before tax and extraordinary items directly. Next, add non-operating expenses. If there are some non-operating expenses like depreciation or interest on debentures, these type of items will come here. Debentures are here, you can see 15% debentures. However, interest is not told about anything regarding the debentures. Interest is not told. Still, as I've told you earlier in the previous video also, that whenever debentures are given, the rate of interest is given, you need to pay the interest of the debentures as well as the preference shares. Whether it is told in the question or not, you need to pay the interest. So 15% debentures are 80,000 and 50,000, and we have seen no additional information was given. Since no additional information was given regarding the issue of debentures, whether they are issued at the beginning of the year or the end of the year, I am considering it end of the year. Since it is to be taken as end of the year, then we need to pay interest on debentures only on the previous balance, not on the current balance, because the issue of debentures for rupees 30,000, you can see here 80 minus 50 is 30,000. Those 30,000 rupees we can take it as it is issued at the end of the year, so we'll pay interest only on this 50,000. When you pay interest on this 50,000 at the rate of 15%, you can see here the rate of interest on debentures is 15%. So 15% debentures on 50,000, that is 7,500. I paid interest on 15% debentures here. 50,000 into 15%, that is 7,500. This will give you operating profit before working capital changes, because there are no more non-operating expenses or incomes. So operating profit before working capital changes are 1,01,000 plus 7,500. 1,08,500 is the operating profit before working capital changes. Next is decrease in current assets or increase in current liabilities. Remember, addition is always done for decrease in current asset. Whenever current asset decreases, we add it. Whenever current liabilities increase, we add it. This we have discussed while doing the operating activities also. Now let us see whether there are any decrease in current assets. Current assets are given here. Inventories, this is increased. Trade receivable, it is decreased from 70,000 to 32,000. 70,000 minus 32,000, the difference is 38,000. It is decreased, so it will be added. And cash and cash equivalent will not be treated now, it will be treated at the last. So there is only one decrease in current asset, that is trade receivable. 70,000 minus 32,000 is 38,000. So I have written here trade receivables, 70 minus 32, that is 38,000. And increase in current liabilities. Let us see the current liabilities also, whether there is an increase. Trade payables 1,10,000 to 1,50,000, there is an increase of 40,000. From 1,10,000 it becomes 1,50,000. So there is an increase of 40,000 in trade payables. And other current liabilities 20,000 to 12,000. So there is a decrease. This will not be taken here. Only trade payables will take 1,10,000 to 1,50,000. That is the increase of 40,000. So trade payable is taken here 40,000. Next, less, just the reverse of that, increase in current assets as well as decrease in current liabilities. So whenever there is an increase in current asset or decrease in current liability, that will be subtracted.